Hi, I'm John Odesi. I'm a business advisor with the Kansas Small Business Development Center at Johnson County Community College. You're a startup when you have less than 24 months in business. And so even if you've been going at it for a year or so, when you go to a bank, they're going to look at you as a startup business. So the thing to understand right now is that banks are not rolling the dice on a startup generally, okay? And so what we see a lot of times is people are looking for alternative funding. And the one that's been around for forever is called friends and family, or actually in our industry we usually say three F's because it's friends, it's family, it's any fool that will part with the cash. And we see that frequently, but that's the way it has always been done. The idea of people going to a bank for a startup was really something that happened mainly in the 80s and 90s. Until now, it was save your money, borrow it from friends, borrow it from your family, and get it going. There are some other banks out there that can handle smaller loans, maybe 20, 25 grand, and they're okay with a startup sort of thing. You don't have to have a whole lot of cash to leverage that. Maybe $2,000 or $3,000, you can leverage 25. But if you ever get a big project where you need $300,000, you're not going to get it from a bank for something that's untested. So it really would be a startup again in that under 24 months window. If you're looking for any kind of funding for a project, you're probably looking to borrow it from friends and family. Um, the An established business, the only way I could see that really working would be if the business wasn't cash flowing. If there was no profit, a bank's going to look at your books, they're not going to like what they see, and they're not going to go for it. So even if you're an established business, if things hadn't been going really well, then you might have to turn to friends and family as well. And sometimes it just takes a really long time for a business to cash flow. I mean, we see things where it's gone 2 years, 3 years before they hit break even, before it starts to cash flow and they make a profit. And so sometimes you just need a little bit more injection of cash to get over that hump. If you're going to go for a bank loan, they're going to require tax records, they're going to require a business plan, they're going to require financial projections, they're going to require some paperwork. And I really think you should take it that seriously. I have seen parents do that with their kids. They haven't just written a check for 20 grand or 50 grand or so. I have a client who owns a clothing store. She borrowed money from a bank, one of those programs I was talking about. She had about 30 grand saved, which was great, but she needed a little bit more cash, and she went to her dad. Her dad held her feet to the fire on the financial projections more than any bank I've ever seen. It was his money. It was hard for him to save that 30 grand. He wasn't just going to throw it away. He wanted to make sure that the deal was going to go. So he had questions about how fast she was going to grow until break even. He had questions about her margins. He certainly had questions about her sales forecasts. So I would say be as prepared as if you were going for a traditional bank loan. Friends and family, it can certainly be a lot faster. If you're talking about a commercial loan for a business, you're looking on the order of probably 4 to 6 weeks to get that thing approved. And it's different. I mean, if anyone has ever bought a car, financed a car, you go into the finance person's office, you're out of there in probably an hour later, and you might have signed for a $50,000 car. A $50,000 business loan is going to be measured in weeks, okay? So it can be a lot faster than that. And it's not going to require the absolute paperwork. I mean, like I said, a business plan, great idea. Your parents, most of them generally won't require it. There are reasons why you would want one anyway. Financial projections would be a really good thing for any business owner to do, to understand what their startup budget's supposed to be, what their monthly costs are, what their break-even point is, how long it's going to be until they break even, how much working capital they need. So those things are not technically required. So I guess we can consider it a little bit more low documentation. I can think of two. First one is that you are putting a cherished relationship at risk here. I mean, you see statistics where 80% of businesses don't survive over 5 years. If someone has invested their savings with you and that added stress on the relationship is there, that can be pretty tough. I mean, if you've lost someone's $20,000, $30,000, $50,000. This is not going to be a pleasant time around the Thanksgiving table this year. So that's, again, the reason why we should really be taking it seriously. This is not found money. This is someone that loves you, someone that trusts you, someone that likes you, and you really are putting that at risk. The other thing would be that borrowing money this way from friends and family there's no credit built for the business. You know, if you're working with an Alterra Bank or a U.S. Bank or one of the ones that works well with small businesses, and they see you be a good steward of your money, they see that you're not overrunning your checking account for the business, they see that you're not there all the time every 30 days for a bump up of your line of credit or for a bigger loan, they see that you handle the cash well. When you do get to the point where you can bring the bank in, the full commercial bank, and maybe it's taking a small home-based business and taking it much bigger, and now we need $250,000, so we got to go to a bank. They've seen how you handle things. You know, you've got a track record with them. At the very minimum, they've seen a deposit record, so they've seen the cash come in all over the years. So, you know, with it not being a traditional bank loan, you're not getting that exposure to the bank. The biggest one would just be to do the math, and if you're not comfortable with that, find someone that can. I mean, that's what we do over and over again. My business card, instead of consultant or business advisor, should say math instructor. We do that every day, and you would be amazed. We had a guy just recently, he was working in the industry, great, and he wanted to open up a small boutique in his industry. He submitted a business plan, and it looked pretty good. The only thing he didn't include on the business plan for his expenses were his own salary, okay? And this guy had a family, he had a mortgage, he had kids, and he needed to bring in $5,000, and that's after taxes. So that's $60,000 a year after taxes, which means before taxes, he better make about $100,000. And that doesn't mean $100,000 in sales. His margin was 23 cents in the dollar, 23% margin. Kind of slim, okay? So when you do the math, this guy has to bring in over $400,000 in sales just to pay his own salary. And he hadn't accounted for that. And actually, with the small size of the boutique shop that he was talking about, it wouldn't have even made the projected sales that he was thinking. Now to be told that, oh my gosh, man, you know, you said maybe 385, and I'm telling you got to do another 415 on top of that. $800,000 out of this little shop that maybe could do $250,000 in a year based on its size. So you got to do the math. Again, you're putting a really cherished relationship at risk here. So run the numbers on this thing.